So, today we're going to dig into the really strange case of PIPPIN, the AI-powered unicorn that seemed totally unstoppable, right up until it wasn't. And look, this is way more than just a story about a price drop. It's basically a digital detective case. So let's follow the data and see where it takes us.
It all kicked off with this number, a 33% drop. I mean, that's a staggering loss, and it sent absolute shockwaves through the project's community. But what made this crash so brutal wasn't just the percentage.
It was the speed. Yeah, this wasn't some slow bleed over weeks. This was a brutal, full-on collapse that happened in just 24 hours. And the financial toll? It was absolutely immense.
$37 million. Now, to put that into perspective for you, that's like the entire value of a small public company, just poof, vanishing into thin air in a single day. So its market cap, that's the total value of all its tokens out there, was just obliterated. Okay, so we've got our crime scene, a massive, massive financial loss. Now our investigation has to figure out the motive.
And this is the central question for us today. Was this just a simple market correction? You know, stuff happens. Or was something a lot more complicated going on behind the scenes? To figure that out, we first need to get a handle on what PIPPIN even is.
Right before we can solve the case, we have to get to know the victim. And PIPPIN isn't your typical meme coin. It's actually this fascinating hybrid of two very different worlds.
And this is really the core idea. On the surface, you've got this fun, unicorn meme, but underneath all that, there's a pretty serious piece of technology at work, and it's built around something called an autonomous agent.
So you should think of it less like a static cartoon character and more like a simple AI that can actually make its own decisions and do things on its own without a human constantly pulling all the strings. So this living AI, it works in this continuous three-step loop. An AI model, an LLM, chooses something to do, like nap or draw or even tweet. Then a memory system records what happened and updates itself, kind of like changing its mood. And then developers can jump in and add new skills. It's this dynamic system that's literally designed to evolve over time.
And here's the rest of the case file for you. PIPPIN lives on the super-fast Solana network. It was actually born from a simple ChatGPT prompt, which is kind of cool. All its art and lore are public domain, and this is crucial. All 1 billion of its tokens are already out there, which means no big, unexpected supply drops can just tank its value. Okay, now we know the victim, let's look at theory number 1.
All right, so this is the straightforward explanation. You could call it the Occam's razor of the crypto world. The idea here is that maybe there's no complex plot at all, just a simple case of the market doing what markets do. Basically, the party was over. The hype started to fade, the big investors decided, you know what, time to cash out, and the price charts started to reflect that reality. It's a classic market cycle we've seen a million times.
And the evidence for this theory, it's actually pretty compelling. The price had already peaked and was clearly trending down. On-chain data shows us that these sophisticated investors, what we call smart capital, were selling off heavily. And it wasn't just PIPPIN. Money was flowing out of the whole meme coin sector and into safer places. So, case closed, right?
Well, not so fast. Because when you start to dig just a little bit deeper into the data, you find this glaring contradiction. A clue that suggests there might be a completely different story unfolding right under our noses. Which brings us to our second theory, and this one is a lot more complex. It suggests the crash wasn't natural at all, but was actually a carefully orchestrated maneuver by whales. These are investors with enough capital to literally move the entire market.
And here's the central mystery. Everything you see on the price chart was screaming sell, which of course creates panic. But at the exact same time, the funding data, which tracks the real money moving into the asset, was screaming buy. So how can both of those things be true?
This theory suggests that these huge players are masters at using price charts, or these candlestick patterns, to create fear. They deliberately push the price down, which causes smaller investors to panic sell their holdings, usually at a loss.
And here it is, the potential smoking gun. While the price was plummeting and all these smaller investors were running for the exits, a staggering amount of new money was actually flowing into PIPPIN. This is the exact opposite of what you'd expect to see during a crash.
$127 million. That's a net inflow of new money. I mean, this is not just small-time market noise. This is the signature of very large players quietly buying up all the tokens from people who are scared off by the falling price. And there's even more evidence to back this up.
Take a look at this chart. It shows how that downward pressure was just amplified. So traders who bet the price would go up, the longs, were forced to sell their positions in a process called liquidation, and they were getting wiped out at a much higher rate than those betting the price would fall. This cascade of forced selling creates a domino effect, pushing the price down even faster and playing right into the whale's hands.
So, okay, we have two competing theories. On one hand, a natural correction. On the other, a deliberate manipulation. What does this whole case really tell us about the wider world of AI and crypto?
The PIPPIN case is a perfect lesson in just how wild this new space is. It teaches us a few really crucial things. First, massive price swings are just the norm here. Second, a project's story, its narrative, is just as important as its tech. And the biggest takeaway? Price charts do not always tell the truth. The key thing to watch for is a divergence. When the price screams sell, but the on-chain data whispers buy, that's a huge sign that bigger forces might be at play.
So where does all this leave us? We've looked at two totally plausible scenarios. You've got the Great Escape, where smart money just decided to move on, and then you've got the whale's trap, where these powerful players engineered a crash just to buy up tokens on the cheap.
You know, the truth is probably a mix of both theories. But the PIPPIN case highlights a really critical question for our digital future. In a market full of AI, memes, and these hidden whales moving billions with invisible hands, how do we ever determine what's actually real? And that right there is the mystery we're all trying to solve.